Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 323rd VideoCast podcast for the week ending December 24th, 2025. Happy Christmas Eve. Merry Christmas to everyone who's celebrating tomorrow. We got a lot of great stuff to cover today, so we're going to get right down to it. But as always, family first. I want to thank our friends Jim and Parvina for having us on their incredible party for the boat parade we got to watch. Very, very grateful. We had such an amazing time. There's Annabelle, Mimi, Caitlin. What a fun time. There's Annabelle out by the ocean with a bird there. More from the party. There's Annabelle in front of the Christmas tree. Zach made an incredible Christmas card here for Hedge Fund Tips. More Christmas stuff with my Grinch Christmas sweater. That was a fun day. And that's that. Here's a picture with beautiful Caitlin at the party. You can see some of the boat parade. Orange County is like nothing else in Connecticut. It's a lot different than snow. They have all the boats decorated up and driving around the harbor, which was just incredible. There's Mimi and Annabelle. They do drones in the air. There's Santa on a surfboard, total California style. There he's drones with Santa on a sleigh. And you can get a sense of all these boats passing by in the harbor with their lights on. That's me and Mimi. What an incredible night. And absolutely a tremendous amount of fun. Very grateful for that. Quote of the week. We have, in the world of business, the people who are the most successful are doing what they love. That's from Warren Buffett. And the second quote from Peter Lynch: know what you own and know why you own it. These are two of the legends. I never feel like I've worked a day in this business. I absolutely love this, and I try to impart that on our incredible listeners here. And our philosophy certainly is knowing what we own and why we own it, which is why we can sit through the short-term volatility until the turnarounds take place, and do it over and over and over again, which is really great. And now I want to get down to some media. First and foremost, I would like to thank Peyton Jennings and Ash Webster for having me on Fox Business this morning on Christmas Eve to talk markets and outlook and AI and more. We're going to listen in here.
Thomas Hayes joins us now. Thomas, let's start with this. What's the biggest expected AI surprise, do you think, in 2026?
Well, Ash, good to be with you. I think even bigger surprise was what happened in 2025 with Intel being the number one performing AI stock. It outperformed NVIDIA twice the returns. NVIDIA up 36% as of yesterday, Intel up 81%. Now, moving into 2026, I think the biggest surprise is the AI beneficiaries are going to outperform the AI cost centers. What does that mean? The beneficiaries are regular businesses, Main Street businesses, the unmagnificent 493 components of the S&P 500 that will be implementing AI to lower costs, increase productivity. The underperformers are going to be the AI cost centers, which are the hyperscalers that are doing all the CapEx. Right now, CapEx as a percentage of operating cash flow for the hyperscalers, Mag 7, et cetera, is over 60%. There's only one other industry that has CapEx that high. That is big oil. And that's why you're seeing some retreat, market getting a little bit worried about return on invested capital. So expect the normal companies to outperform in 2026. We started to see tastes of that in 2025 with Amazon up only 4%, Apple up only 8%, Microsoft up 15%, and Intel up 81%.
I got about 30 seconds, but there are a lot of analysts who say, look, that's all great, but we must have a broader market advance, that it can't be this narrow, sector of stocks leading the way. Do you agree with that?
I agree, and I think that's going to be surprising for people that that's exactly what takes place in 2026. As I said, the regular everyday businesses implementing that. And one of the biggest beneficiaries, Ash, is going to be healthcare, that it uses it to increase margins, lower costs, but specifically for AI drug development. Healthcare tends to outperform in midterm election years when there's volatility. On average, since 1950, up 9%, whereas the S&P up only 2%, just over 2%. So you definitely want to play the broadening theme, and you want to play the groups that are utilizing AI, not the ones that are investing all the capex, where most people are crowded in those stocks. So if you're focused in there, you might want to trim back and play the broadening theme in 2026.
Great stuff. Really interesting and informative. Thomas Hayes, as always. Thank you, Thomas, for joining us on this Christmas Eve. Great to see you.
Thank you. Merry Christmas.
We are. Merry Christmas to you. We're taking.
And we're back. And then I would also like to thank, besides Peyton Jennings over at Fox, I would like to thank Justin Oliver over at Yahoo Finance and Brian Sazi for having me on this morning to go into a pretty detailed outlook for 2026 and beyond. We're going to listen in here.
All right, we are being reminded in the final stages of 2025 that it's the AI trade that stirs the drink for portfolios. This will probably be the case in 2026, especially as companies like Meta and Amazon spend hundreds of billions of dollars to build out AI infrastructure in this country. Thomas Hayes, Great Hill Capital Chairman and Managing Member, and Angelo Prokofis, Edward Jones, Senior Global Investment Strategist. I know have some thoughts on the AI trade. Going to start with you, Thomas. What has surprised you this year on the AI trade?
Well, I'll tell you, Brian, it wasn't a surprise for us, but I think it was a dramatic surprise for the market and may still surprise some people when they hear it right now. The number one performing AI stock for 2025 was not NVIDIA, it was Intel. Intel was up, as of yesterday, 81.4% year to date.
Intel's still around, Thomas. They're still around. They still do business?
They still do business, and the world, all of the chip designers are dramatically dependent on them succeeding in developing advanced chips. And the U.S. government is standing behind that because we don't want to be dependent exclusively on Taiwan Semiconductor. So Intel was the number one chip and hyperscaler, followed by AMD. So Intel was up 81%, AMD up 77%, NVIDIA up 36%, not bad, but less than half of the returns of Intel. Microsoft only 15%, Apple 8%, Amazon 4%. So I think people were a little surprised that the most popular names were more subdued than expected. And I do think that theme is going to persist, but we'll get to that.
Angelo, hit me with a surprise. I think that Intel move, the fact that it outperformed NVIDIA, certainly has surprised a lot of folks. What's been on your radar?
Yeah, I think one thing that may surprise many of your viewers is that valuations for the tech sector are lower now than what they were at the start of the year. So basically what has happened is that earnings have been growing faster than prices. So that pushes back against all that AI bubble narrative, because it is really earnings that have been doing the heavy lifting for the tech sector. And that, I think, is a comforting message. Yes, tech is the most expensive segment of the market, but it has been able to deliver earnings, solid earnings. And what has happened late in the year is probably a healthy pause, but the AI theme is likely to continue.
These are the surprises I needed. Tom and Angelo, you have clearly brought your A game here on Christmas Eve. Tom, back to you. I think Angelo makes a very good point on valuation. So question to you, are AI stocks still cheap then?
I think that we have to be a little bit careful as we look into 2026. I think the theme is not going to be the AI stocks or the AI cost centers, rather, when we think about hyperscalers and some of the chip names. The theme for 2026 and the biggest surprise is going to be AI beneficiaries, those that are implementing the technology into their businesses to improve productivity, to improve margins. And to Angelo's point, earnings have grown, but if we look out 3 quarters, it's expected that the earnings growth rate of the Magnificent Seven relative to the earnings growth of the unmagnificent 493, we could say cost centers versus AI beneficiaries, is going to converge, meaning the unmagnificent 493's earnings growth rate will be equal to or greater than the Magnificent Seven earnings growth rate by the 3rd quarter of this year. And that's why I think we're going to see, as we see in midterm election years, the indices a little bit more subdued, a little bit more choppy, a little bit more volatile, because the biggest weights of the S&P 500 are probably going to take a breather or consolidate their gains as that earning growth decelerates. The other thing that we have to keep in mind here, Brian, is that CapEx as a percentage of operating cash flow now for the hyperscalers is exceeding levels of big oil. Greater than 60% of operating cash flow is now going to CapEx, and that's part of the reason that that growth rate is declining. And I think we're going to see a lot of money made under the surface in individual stocks, the AI beneficiaries, and maybe more subdued returns again from the AI cost centers, aka hyperscalers, and the stocks that most people are crowded into at the moment.
Angelo, talking about subdued returns, this year hasn't been a great year, relatively speaking, for Meta and Amazon, but Amazon in particular up only 5%. I mean, that's an ugly performance versus the S&P 500 and the rest of the Mag 7. If in January, would you be inclined to buy these AI laggards like a Meta and Amazon?
I think our call for next year is rotation both within tech and outside of tech. It is interesting that 4 of the 7 Magnificent Seven names have lagged the S&P, but that's followed multiple years of very strong outperformance. So I think some of that rotation is healthy. We are seeing potentially the early stages of the move from the companies that really enable and facilitate the build-out of AI towards the companies that are adopting it. And I think that's going to include a broader set of opportunities for investors. And that is beyond tech as well. Thinking about industrials, healthcare, these are some sectors that we see potential benefits flow through. But I think the name of the game is diversification, not concentration in 2026.
Tom, tell me if I'm totally off base here. So you have the Fed cutting rates. Maybe they come in with one more rate cut early next year. You have a whole class of people that have been making bank off of CDs, low-risk investments. Are they now forced back into this market to earn a good return?
They are forced back into the market, but guess where they're forced back into is probably one of the most unloved areas of the market. As a matter of fact, dividend payers are the most out of favor and lower relative valuation than they've had in 25 years.
That makes no sense to me, Tom. I mean, we're supposed to like dividends. We're supposed to champion dividends. We want this check coming to our mailbox every quarter.
Well, there's no question. And exactly to your point, as the Fed cuts and that free interest payments on those money markets goes down, they're going to be forced to find the yield elsewhere. That's going to be dividend payers. Now, what is dividend payers? Where do you find the dividend payers? Well, you tend to find them in defensive stocks, consumer staples, healthcare. Some of the stocks now, if you look at healthcare in particular, lowest weighting in the S&P in a handful of years, lowest relative valuation to the S&P in 25 years. I would say right now is a generational buying opportunity in the healthcare sector. Oh, and by the way, in midterm election years, healthcare dramatically outperforms the indices. Since 1950, the S&P tends to be more subdued in midterm election years, about 2% returns. Well, guess what? Healthcare does over 9%. And the last 3-4 years, you couldn't give healthcare away. So expect good things from healthcare for a couple of reasons. One, the dividend yields. 2, it tends to do well in volatile periods. And 3, I think it's going to be one of the major AI beneficiaries, not cost centers, aka they're going to use AI to lower costs, increase productivity, and in a material way in drug development. So healthcare is the name of the game for 2026.
Angelo, next year, is that the year of the dividend?
I think it can have improved performance relative to the other years. We like mid-caps as well, thinking about asset classes. Mid-caps, some international, still emerging markets. We talk about AI and technology, but there's a lot of innovation also happening beyond the US borders. And as you talked about the Fed and slightly cutting interest rates next year, that gap now between cash returns from CDs, money market funds, and either you talk about fixed income or dividend-paying stocks, that gap is going to widen. So we could see some rotation out of heavy excess investments for many investors into cash towards other asset classes.
Tom, real quick, do you chase gold here?
No, we like productive assets, but just to jump on what Angelo said, he pointed to mid caps. Well, look at the earnings expected growth rate of the S&P at 14%. How about small caps? Expected earnings growth of 55%. They're just coming off the mat. I think you can get a lot of bang for your buck in 2026 in small caps as well.
All right, guys, stick with me. We got a lot more coming up here on Opening Bid. Straight ahead, not on Opening Bid, I should say Morning Brief. Straight ahead on Morning Brief, I'll spotlight a few hot tickers lighting up the Yahoo Finance platform this morning. Got to get my shows right. Welcome back to Morning Brief, presented by Robinhood. Now time for some of today's trending tickers. We're watching BP, Sanofi, and UiPath. First up, BP. The energy company says it has reached an agreement to sell a majority stake in its Castrol lubricants business. The shareholding has been sold to investment firm Stonepeak in a $10.1 billion deal. Upon completion of the transaction, a new joint venture will be incorporated, comprising a 65% Stonepeak and 35% BP ownership. BP noting that its retained stake provides exposure to Castrol's growth plan while retaining optionality to realize further shareholder value in the future. Next, Sanofi announcing it has entered into an agreement to acquire Dynavax Technologies, the biopharma company aiming to augment its presence in adult immunization with Dynavax's vaccines, adding that Dynavax's adult hepatitis B vaccine and shingles candidate brings new options to Sanofi's portfolio. The acquisition involves a cash tender offer to acquire all outstanding shares of Dynavax, reflecting a total equity value of approximately $2.2 billion. Finally, UiPath seeing shares pop as the company is set to join the S&P Mid-Cap 400 Index. The stock will join the index before trading starts on January 2nd, 2026. UiPath is replacing Synovus Financial, which is being acquired by Pinnacle Financial Partners. This move for UiPath comes as the automation software company has seen over 20% gains so far this year, and even solid gains this month following its earnings release. UiPath reported upbeat third quarter results that saw better than expected earnings and revenue. All right, 2026 is fast approaching, but first, lessons learned in 2025 with an economic twist. As I wrote on my LinkedIn page this morning, I'm surprised consumer spending hasn't fallen off a cliff, given tariff-related price increases in a lot of categories found in supermarkets and malls. Yet, consumer spending grew at a strong 3.5% pace in the third quarter, largely a function of strong spending by higher-income households. So what did I miss, and what does it mean for next year? Tom Hayes, Great Hill Capital Chairman and Managing Member, and Angelo Kokafis, Edward Jones, Senior Global Investment Strategist, are here. Tom, back to you here on this. Can this spending within the high-income household, which I would argue has held up consumer spending this year and the broader stock market, can that continue at its pace next year?
I think it can. I think you look at household balance sheets, cash levels at 7% are the highest since 1950. So there's a lot of dry powder on the sidelines. I think you have a little bit more volatility picking up in the market in the midterm election year that might create a little more subdued. But if you look at consumer sentiment, man, it is washed out and people are still spending. They're saying I'm depressed, but apparently they're taking that depression and they're going to the stores and spending money.
Tom, nobody wants to tell the world they're rich. Nobody wants to say it. They just want to live under the radar, buy their Rolexes, and just don't tell anybody, Tom.
Yeah, but listen, you can't make this up. Consumer sentiment is lower than it was during COVID, the great financial crisis, and the Volcker crush in 1980. And things are relatively good. So I do think there's some tailwind behind this. I think the consumer can spend. We saw it yesterday, spending at 3.5%. We saw it in GDP, 4.3%. GDP now for Q4 is over 3%. Holiday spending looks pretty good this year. So I do think that's going to persist. And And I do think that you're going to continue to see an increase in real wage growth. Let's hope we see some more benefits to Main Street in 2026. And I think that could be the theme moving forward versus just the upper end carrying the water, seeing everyone participating and benefiting from some of these pro-growth economic policies.
Angelo, is next year the year of Main Street? That Main Street finally starts to feel a bit better, and they got out and spend in places outside of dollar stores.
It's been more than 2 years that wages have been rising faster than inflation. It's a process that takes a while for consumers to feel confident that they are catching up. But the combination of still a solid labor market yet slowing, and at the same time gradually moderating inflation, that is a good mix. When we talk about the macro, it's all about growth and inflation. And we've seen positive surprises on both fronts. So I think it looks favorable, the backdrop for next year. And as they say, never underestimate the US consumer. And especially, as we talked about, balance sheets continue to look and remain healthy.
Yeah, we can't help ourselves, Angelo. We all want that 10th big screen TV. We all want it. We can't help ourselves. But Angelo, is it as simple as to say that the stock market is at records and that's what's fueling spending with higher income consumers? Or is there something else going on here we need to know about?
No doubt, that is a big supportive factors. The stat is that 10%, the higher the top 10% on the income categories, they account for 50% of the spending. And we've seen gains not only in equities, in fixed income. Talk about investment grade bonds that had the best year since 2020. Real estate prices have been appreciating. And yes, we are stuck in this low hiring, low firing type of labor market. But at the same time, the unemployment rate remains historically low. So, I think that, again, is a positive as we head into the next year.
Tom, hit me with a potential economic surprise for next year.
Well, I think the surprise is we're underestimating what's happening. We're having both guns blazing with an easing cycle with the Fed. We continue to ease, we continue to cut, but by the way, QE light is back. The Fed is going to be in the market buying $40 billion of T-bills at least through April. So that's going to add a tremendous amount of liquidity. You had over 320 global central bank cuts in 2025, highest you've seen since the great financial crisis. That works on a lagged effect. So you have a lot of liquidity there. You got these tax refunds of $1,000 to $2,000 going out to Main Street. You potentially have, if the Supreme Court turns off the tariffs or unwinds them in a way, Trump is not going to give that money back to foreign entities. He's going to pay it out as dividends, and then he's going to figure out how to do the tariffs in another legal framework. So you could have a tremendous amount of fiscal stimulus coupled with an easing cycle, coupled with rising wages, and really benefit Main Street in 2026. So I think people are kind of underestimating not just the earnings growth, not just Main Street, but fiscal and monetary policy, guns blazing going into 2026. That's a positive.
I'll weigh in with a surprise here. I think what we're going to see on the GDP front is going to shock the hell out of people. And I mean to the upside. We have AI infrastructure being built out aggressively in this country. You guys are talking about higher wages. We've got rate cuts, lower rates from the Fed. I mean, Angelo, the ground is set for, I think, some serious upside to economic growth in this country next year. But if that does happen, what does that mean for the outlook for rates?
Yeah, I think the key in all of this, to connect all of these dots, is productivity. Let's look at corporate profits. Corporate profits have been booming without companies adding much headcount, and that implies real productivity gains. Maybe too early to say that all is AI, but since after the pandemic, we know that technological adoption really accelerated, and potentially we are in this period of sustained productivity gains. So the Goldilocks is if we can sustain above trend growth for a while without generating inflation. Our call is that with economic growth holding steady, potentially even above 2%, the Fed slightly cutting rates towards 3 to 3.5%, maybe the 10-year yield doesn't have necessarily much downside below 4%. So we're looking at range-bound yields, but still a Fed that kind of moves more closely to that neutral rate, again, between 3 and 3.5%. So not much downside, but you don't really need to as long as the economy continues to perform as it has.
Tom, 30 seconds left. Do you have one investing resolution top of mind for yourself for next year?
Well, I think we're going to keep doing what we did in 2025 because it worked. I think the thing that is going to surprise people is that equal weight indices could outperform cap weighted indices. I think people who are just stuck in regular cap weighted indices like the S&P 500 are going to be underwhelmed with their returns in 2026. And the people that venture out a little bit, either the stock pickers, I think there's going to be a fortunes made under the surface, but the easy way to get exposure to that is with an equal weight index, in which case would be the first time in some time where the broadening and that participation overwhelms what people expect in the indices. And that's a sign of health. That's a good thing, not a bad thing.
The future favors the bold. Happy holidays to you both, gents. Appreciate you taking the time here. We'll talk to you soon.
Thank you.
Thank you.
All right, that does.
And we're back. Then I want to thank all of you. Apparently, a lot of people did Christmas shopping and are getting a ton of hedge fund tips, hats and mugs and shirts, and hoodies have been super popular. I love the hoodies. They're super warm. And then sending in their incredible photos wearing the merch. That's the name of the game, guys. How this grows and why I keep putting it out free every week for clients and non-clients alike and delivering this value is because you guys are doing a great job of sharing. So if you're getting value and it's really helping you and you're making money, share it with one person you love that could benefit from this information. We'll continue to grow. We'll continue to put this out. And an easy way to do it is wear the hat, wear the mug, and people will ask you about it and give back to the community, and then send in a picture so we can get you on here with everyone else. We've got a lot of great data to cover this week. Let's start with this chart from PayPal. You can see the free cash flow yield is nearing a record high at 10% free cash flow buying the stock at this price. We're super excited for 2026. Key article here from American Banker. And he's talking about, 200 countries, 430 million active customers, 35 million merchants, $2 trillion in payment volume. They're doubling down to use PayPal's vast scale to power new forms of artificial intelligence, blockchain in its digital wallet. He ran into its small business group. We know all this. PayPal's betting big on agentic AI to support its omni-channel payment strategy. Agentic commerce services, they're a leader there. Agentic commerce is the next phase, says Chris. We're making sure an AI agent can make payments, figure out where they are, and find out what store is down the street and what it is they want. PayPal enabled its merchants to become discoverable within Perplexity through its identity verification, couple other things. Huge opportunity. PayPal's partnerships in generative agentic will give it an advantage. Inclusion into ChatGPT's instant checkout will make PayPal's branded wallet available as a payment method within instant checkout for merchants who opt in. So just on and on, really great stuff, talking about their partnership. Google, Amazon, and PayPal, through its partnership with Google, have agentic scale access to PDP. Partnership with Google gives Alex Chris a direct ride on Gemini's growth and agentic dominance. People are really underestimating this. This is why we continue to buy shares like crazy this week. And we're going to see some exciting things from PayPal in 2026. Boost brand checkout and international payments are two areas PayPal hopes will drive its growth in the future. Has evolved towards a digital wallet, etc. So let's talking about agentic AI being transformative for the business. This is not embedded in the price of the stock, not to mention 10% free cash flow yield, 6 to 7 billion. Oh, and by the way, they buy in 10% of the stock every single year. So your slice of the pie gets 10% bigger without putting a new penny. So we're excited for that one. Biggest surprise of this year, not for the Hedge Fund Tips with Tom Hayes community. Intel was the #1 performing AI stock in the semiconductor and hyperscalers, better than better than every Mag 7, up 81% year to date as of yesterday's close, more than double the returns of Nvidia, more than 20 times the return of Amazon, more than 10 times the return of Apple, more than 6 times the return of Meta, more than 5 times the return of Microsoft. So it's been a great, great year. We're super excited. You couldn't give it away under 20 when we were pounding the table on Varney last September of 2024. And there you go. Here is talking about sector rotation from Strategas. We've covered that a million times over. CapEx is now returning, depressing cash return on equity. We've been talking about that theme, and we re-emphasized it with Ash Webster and Brian Sazi on the media hits this morning, which you heard. We've got US dollar index kind of mimicking what happened the first term of Trump's presidential election. First 2 years, expect continued weakness, ladies and gentlemen. By the way, that is going to help our newest position in healthcare, which all the new clients that have been coming in for this quarter have been getting in their portfolios. All the existing clients, pretty much every single one of you, I was able to find room and get in this. 64% of their sales are ex-US, so the weak dollar will give them a boost in 2026, as well as the healthcare theme. We love this one, and we can't wait to bring this out and release it. We're doing the write-up, and we're getting everyone lots of shares. So super excited for that. On to the next. Healthcare stocks are undervalued. This is why we took profits on XBI and the biotech, and we've added a third healthcare position. We want to take advantage of this once in a generation. Healthcare has not been this cheap or this low a weight in the S&P going back 25 years. Not to mention healthcare outperforms in midterm election years, up 9% versus the S&P, up 2% since 1950. Those are averages. Healthcare positioning is starting to build up, but nowhere near where it's going to be. Mortgage rates are starting to converge with treasury yields falling over, which is going to be positive for housing. They think Generac, Stanley Black & Deckers, QXO, etc. Tech bubble. This is global defensives as a percent of global market cap. You haven't seen this level extreme since 2000, when tech cooled pretty aggressively and defensive staples, and I would put it as the unmagnificent 493, the non-Mag 7 type components started to outperform. This is really an opportunity for the way this community is positioned and clients have been positioned. So we're super excited. Okay, core inflation eases to its lowest level since 2021. Many of the pundits were calling for the opposite. Those of you who are on this podcast knew better, and you took advantage. Nearly all major equity markets have outperformed the U.S. in 2025 in local and in USD terms. Ladies and gentlemen, that was a core theme for us in 2025 and helped us shoot the lights out, and we're very grateful for that. Transition to technology. Hybrids are poised to grow in coming years. That helps Cooper Standard. Value versus growth dynamics have been diverging between the US and Europe. In other words, Europe's value has started to take off, US value just starting. But that's such a broad term. It's like, with what we were able to achieve this year, and we're considered like value tilt type manager, what we're doing is entirely different than traditional value, which is just buying cheap stuff and getting trapped in it. We're doing turnarounds with a catalyst, and we're buying great businesses at we're buying good businesses at great prices versus great businesses at good prices, because great businesses at good prices, that's a good way to compound your money at 20%. Good business at great prices is how you can shoot the lights out over time if you know how to do the underlying fundamental analysis. Great prices are not always great prices if something is cheap for a reason, and that's what we do here, and that's what we teach and help you try to understand, is how to distinguish between temporary impairments and permanent impairments with good businesses. Household wealth is growing for the bottom 50%. Let's see, active equity flows, CPI, housing inflation coming down. It's good to see that. Household cash as a percentage of total financial assets is now 7%, 98th percentile, highest rate since 1950. I'm telling you what's going to happen, ladies and gentlemen, as rates continue to come down, money market yields continue to compress. That's all going to be forced into the stock market from people looking for yield, and dividend payers are going to fly. Cheapest relative value, most underappreciated bucket of the market since 2000. Get ready for a dividend payer boom, which is consumer staples, defensives, healthcare, which we're positioned to take advantage of. It also helps housing, by the way, which we are also positioned to take advantage of. Annualized returns of U.S. stocks by size. This shift is going to go to small caps because small cap earning growth 55%. Lower rates help small caps refinance, and the multiple is lower than large caps. So you get triple the, almost quadruple the expected earnings growth for slightly less multiple. That's a formula for success, and lower rates is the catalyst. It is the spark that lights the fire. Almost everyone is very long stocks. When they say this, though, you know, what that implies is indices. Indices are cap weighted. Cap weighted is Mag 7. And yes, those guys are getting and going to get relatively torched, maybe not absolutely torched, but certainly relatively torched to those who are playing outside that crowded space. Japanese 10-year yield highest going back to 1999. This is what we call a carry trade unwind, ladies and gentlemen. That's part of the reason that you're having pressure on the Mag 7. And we were early in telling you this would happen about a year and a half ago. And here we are today. Bull bear indicator stretched, a little bit of exuberance. If you're in the crowded stocks, I'd watch out after the first of the year or be a little bit cautious. Here is earnings growth. Russell 2000, 55% next year. S&P 500, 14%. We've got a lot of great data this week. Median size of new single-family homes is declining. This was another thing that we called early on would happen, and that's going to improve the housing affordability. Not every 23-year-old needs 4,500 square feet and an indoor pool. How about like the 50s when we had the housing boom? Think Levittown, 1,500, 1,200 square foot houses on a slab, have your first kid or two and a dog, upgrade, get in the game. By 35, you're upgrading to a 4,000 square foot house and off to the races. Existing home sales starting to pick up. New vehicle average transaction price has now leveled off. This is helping Cooper Standard. We're going to talk about that in a second. Lennar's average selling price net of incentives is down 21.4 from its 2022 peak when factoring in incentive spending. The decline narrows to negative 10.8% from peak. We want to see volumes helps QXO, volumes helps Generac, volumes helps Stanley Black & Decker. Building, we don't care about the margins of the builders, just like we don't care about the margins of the auto suppliers. We want to play Cooper Standard. We are a pick and shovel kind of guy, and let the rest dig for the gold and gamble and win or lose. We could care less. We're the house, we're the casino, we're not the gambler. Here we go. Looking at some restaurant stocks. This sector has been absolutely decimated, left for dead. We finally found a play in it with a friend of mine was telling me I was saying the name of our pizza place in my old town in Connecticut. Papa John's, we love this one, especially with $1,000 and $2,000 increases in tax refunds. You know, Papa John's is not, it's funny, I sent out gift cards to all of my clients for Papa John's this year. Last year, we sent them vans. We always try to send something from the portfolio. Number one, so they can see what they own. And number two, so we can boost earnings for their holdings as owners. So all these centimillionaires and billionaires are having their Papa John's, but for the regular folk, normal people getting $1,000 to $2,000 refund checks in April and possibly $2,000 tariff checks, and the military who got $1,776 dividend checks. Those people can feed a family of four for $20 at Papa John's, and I'm telling you, when that extra discretionary income comes in, they're going to do it in spades. Russell 2000 earnings growth in this Goldman Sachs note, consensus is 61% earnings growth, which would be the highest we've seen since 2021, and then going all the way back to 2010. So we're excited to see that, and that was kind of the norm in the early 2000s when small cap value outperformed everything. Expects similar outcomes in coming months and years. So these are some factors that they're putting into play to make housing more readily available, lowering land use restrictions, et cetera, et cetera, et cetera. Herd mentality, unanimously bullish and clustered. I think it's going to be a subdued year for people who are crowded into passive indexes that are market cap weight. I think they're going to be sorely disappointed, 0 to 8%. And I think fortunes are going to be made under the surface by stock pickers who know what the hell they're doing, and people in the right sectors. And even if you can't do that, buying an equal weight over a cap weighted should help you along the way, probably by a few full percentage points of performance. On to the next, consumer sentiment, lowest since COVID lows, even lower than the great financial crisis, and down to the Volcker lows, and then back to the early 50s. That's generally bullish. When it gets this negative, is usually a good time to be buying the right type of stocks. Owner's equity in real estate continues to climb. That's the wealth effect. Equity funds towards large inflows, blah, blah, blah. All right. Pretty good job with the data in a short holiday week. S&P, once again, concentrated in expensive names. Price to sales greater than 10 times is an extreme, even after adjusting for select number of mega caps. It hasn't been this extreme since 2000, both on the cap weighted and the equal weighted. So I would strongly remind you, if you were in crowded trades, get someone who knows what the hell they're doing, or get out of the crowded trades and lighten up. Don't be a pig. Pigs get slaughtered. Federal Reserve balance sheet down 2.43 trillion. They're starting up again. QE light, 40 billion a month of bond purchases. That is adding liquidity. That is QE again. That is positive for risk assets. Small cap equity position just starting to increase. Here are the leveraged long ETF assets. As you can see, when it hits this level of peak, expect some more consolidation. And that's, again, going to hit the most crowded trades in the cap-weighted indexes. Analysts expect China AI capex to rise, but at a much smaller scale than the U.S. Their earnings are going to rise much faster than their capex. In the U.S., the opposite is true. U.S. economy expands at the fastest rate in 2 years. We saw the GDP numbers this week for Q3. For Q4, GDP now is at 3%, also very positive. Normal December seasonality playing out. We're right here. Tends to be strength into the end of the month. U.S. mid-caps trading at a PE of 15 times versus 22 times. That relative PE of 0.7 is the lowest rate we've seen since 1999 and 2000. So alongside the small cap theme, this is a generational opportunity to get exposure to mid-caps, like the new position we put into the portfolio, like the VF Corps of the world, like quite a few of our companies are mid caps, and that's going to benefit greatly in coming months and years. International stocks outperform U.S. peers. We said that was coming this year. It will persist in 2026. And that's it for the data of the week. Now on to Alibaba has soared. China tech stocks can ride the AI wave further, says Goldman. Opinion follows trend. None of them were interested at $60. Everyone's interested at $150 and going higher. This stock has the potential to double again, but it's going to take another 3 years to do that, which slows down the IRR, which is why new client money is not aggressively going in there. We were buying till our fingers bled at 60 at the lows, brought our basis down to 82. Now we're just enjoying the ride and holding all of our shares through to the promised land. How Warren Buffett did it. This is by Seth Klarman in The Atlantic, one of the best articles I've read. Go ahead and read that when you have time. Go to google.com. Cox Automotive forecast, despite Q4 slowdown, new vehicle sales forecast to reach 16.3 million in 2025, up from 2024. Best results since 2019, which means Cooper Standard's going to be smiling so wide they can eat a banana sideways, minting money as the volumes grow, and we're nowhere near the cycle peak, which we think it can earn $10 a share as opposed to its last peak at $7.19 a share of earnings in 2017 when it was a $146 stock. So we're early days and we're super excited on that front. Let's see what we've got here. We've got the Bloomberg massive security thing, never letting me into my own subscription. EV sales growth is slowing. Are hybrids the solution? They are for Cooper Standard. We love the cost per vehicle and the amount of parts that they sell into hybrids. Disney stock is the analyst top. This analyst top media pick, why it can bounce back. We love Disney. We've got it, a lot of it in the mid 80s. We've had it for some time, and now they're talking about catalysts for acceleration between streaming, between parks, between cruise business, highest return on capital business in 2026. We love it. We agree. Avatar 3 tops China box office in another win for Disney. They're crushing it at the box office, by the way, with all their films this year. Holiday retail spending rose 4.2% this season, driven by e-commerce and electronics. That's even more pronounced in China, which Alibaba is the toll taker, which we love. Retail stocks could get a tax refund boost in 2026. Picture of Nike sneakers. What they should have is a picture of Vans, because skateboarding is all the rage. If you look at the Paris Fashion Show, it was all skater shoes. And with the high-end collabs they have with the Valentinos and everything else, it's going to be a great year for VF Corp and Bracken, aka Growth Daryl. For those of you who missed the interview I did with the CEO of VF Corp, aka Vans, Timberland, North Face, just go to Hedge Fund Tips. Go to YouTube, type in Hedge Fund Tips Bracken Daryl, and you will see that full interview. Early days on that stock, despite its recent move higher. Bessent sees room for a future revamp of Fed's 2% target. You heard it here first. I said 3% is going to be the new 2%, and we have not changed that view. Bessent is driving the bus. Home sales climbed to a 9-month high as sellers finally give in. Affordability is happening. The air pocket is here, and it's going to continue. As rates lower, this time will be different, because we're going to get a lot of boomer supply hit the market all at once. Everyone thinks when rates go down, prices will go back up. It's the opposite this time. A lot of supply is going to hit the market all at one time, and it's going to overwhelm the amount of buyers, which is going to put them in the driver's seat. which is, well, anyway, that's that. This $27 billion home builder says the feds are cooking up something big to address housing market affordability. Home builders are in discussions with the Trump administration. He says, do I think something will come out of 2026? I'd be surprised if something isn't done, whether that's portability of the mortgages, opening up a federal land to build, a lot of options in the tank. Stanley Black & Decker's $1.8 billion aerospace unit sale will ease debt load. What we look for in turnarounds besides solvency risk, we do the balance sheet first, we do catalysts, we look at the jockey. Often there's a new jockey, and then we look at their outs. If for anyone that plays poker, we always look for outs. And in the case of VF Corp, they had a lot of outs. They were able to sell Supreme, pay down debt. They were able to sell Dickies, pay down debt. Now they're in growth mode. Same thing with Stanley Black & Decker. They sold their $1.8 billion aerospace unit. Now they are a lean, mean fighting machine with massive operating leverage to ride the housing building recovery wave. Mergers and acquisitions soared this year. That could make 2026 even bigger. Animal spirits are back. Small cap stocks are winners. Let the good times keep rolling. That's from Jacob Sonnenschein. You heard it here first. We've been pounding the table on that theme, and now it's playing out. Article of the week. Setting up the second act stock market and sentiment results. We went through the media. We're going to talk Pfizer, which is a newish position we bought in the past couple of months on weakness. You can see here free cash flow reaccelerating, revenues reaccelerating, margins reaccelerating, and so on. You see sales per share growing, cash flow per share growing, earnings per share growing. Dividends per share continue to grow. You got a 7% yield right now alone. Get paid while you wait. Margins are growing, and share count is static, which is okay. They'll start buying back as cash flow continues to ramp up, or they can't find external investments that give them a higher return on invested capital than the inverse of call it 8 times earnings. So 1 divided by 8, and you got yourself 1 divided by 8, a 12.5% earnings yield. So they need to find investments that yield greater than that, which they're finding all day long in the CGen, in the Metsera, as you look at the long-term results. So healthcare. Pfizer is a name that came across our desk many times over the years, and we recently pulled the trigger, building a nice size position on weakness. For those of you who've been on the last few podcasts, you know it's a unique, or clients looking in their account, you know we positioned uniquely in this position, unlike anything we've done before, so that we can make a multi-bagger. Even if the stock itself is not a double, we can make 4 or 5x on our money. We've positioned that uniquely because of the Black-Scholes model on some of the instruments we're using to express that positioning, and we're very excited about. So we first laid out our thesis publicly on Fox Business December 4th, along with several other media appearances that same week. We expanded on you can watch it there. We expanded on the thesis at a more granular level at the Money Show in Sarasota, where we presented the full Pfizer investment case. See below presentation. And the times are here, 23:57 to 33. You can find that on my YouTube channel, or just go to hedgefundtips.com and click on the article setting up the second act. While you're at hedgefundtips.com, click on terms. This is all opinion, not advice. Consult your psychic before doing anything else. And that's that. This was a good presentation. You should check it out if you want an outlook of the whole 2026. Healthcare has been an area of the market we've kept a close eye on, and one where we've been looking to add additional exposure alongside our existing holding in Baxter International. And now we've got a third one, which we announced that we have, and clients have been able to take advantage of, and new clients who've come in early to take advantage since we opened last week for our quarterly openings for the small accounts of 1 million plus, and intra-quarter for the large accounts of 5 million plus. You guys all have it. The sector has become one of the most dislocated sectors of the market, battered by policy and regulatory headwinds, and driven into 3 straight years of underperformance. This resulted in a 51-point cumulative lag behind the broader market, making it the worst stretch on record. We love those environments. The ensuing forced selling and rush for the exits pushed the sector's weighting to under 9%, a sharp retreat from over 15% in 2022 and reminiscent of levels not seen since the early 2000s, a setup that preceded a multi-year stretch of outperformance, ladies and gentlemen. This shoot first, ask questions later environment left a long list of high-quality healthcare companies on the clearance rack. We quickly rolled up our sleeves and started digging through the rubble in search of a pony in the pile. What made the setup even more compelling was the backdrop of a midterm election year notorious for elevated volatility. Such conditions played directly into the strengths of resilient, durable demand sectors like healthcare, which has a consistent track record as a top performer in midterm cycles. In fact, the sector has outperformed in 11 of the last 13 midterm years, posting average annual returns of 9.03% and dwarfing the broader market's modest 62 basis points of returns. With that framework in mind and a willingness to lean against the prevailing narrative, we went hunting within the sector and eventually zeroed in on a name offering asymmetric upside while trading at life support valuations. That name was Pfizer, founded in 1849. Pfizer stands alone as one of the world's largest pharmaceutical companies with a broad portfolio spanning vaccines, oncology, and immunology. If you think this is the first time Pfizer has found itself in the gutter over its 176-year operating history, think again. Through wars, depressions, and countless cycles, this company has seen it all and consistently emerged stronger on the other side. Today, Pfizer markets 9 blockbuster products led by Eliquis and the Prevnar family, and delivered the top-selling COVID vaccine, Comirnaty, and oral treatment Paxlovid during the pandemic. The stock remains down more than 60% from its COVID-era highs when the company was effectively king of the world, and its twin COVID franchise generated $90 billion in supplemental revenue and $40 billion in incremental free cash flow in 2021 and 2022 alone. That windfall faded much faster than management or the market anticipated. By 2023, revenues had fallen more than 40%, forcing large inventory and intangible write-downs and sending adjusted EPS down 72%. The resulting COVID volatility and uncertainty created a massive overhang on the stock, one we believe is now firmly in the rearview mirror. The core business has stabilized in the low $60 billion revenue range, with earnings power recovered to a solid $3 plus baseline, and COVID products representing just 8% of sales, a fraction of the 57% peak in 2022. Despite this stabilization, the market continues to fixate on the lingering COVID shadow and the impending patent cliff, with key blockbusters, Ibrance, Eliquis, Zandy, and Prevnar facing loss of exclusivity between 2026 and 2028, putting $17 billion in annual revenue at risk. We believe this pessimism is far overdone and overlooks the heavy lifting management has already delivered to right-size the business and offset these headwinds. Pfizer launched a $7.2 billion cost savings program aimed at restoring operating margins to pre-pandemic levels while reinvesting $500 million to strengthen R&D productivity. Management has executed aggressively, already delivering $5.1 billion in savings and putting the company on track to achieve the full $7.2 billion by 2026, a full year ahead of schedule. More telling, rather than relying solely on cost cuts to offset patent expirations, management went on offense with the COVID cash, going shopping for the next generation of growth drivers. The $43 billion Seagen deal added 4 approved cancer drugs and a leading oncology pipeline that management expects to scale from $2 billion in revenue to more than $10 billion by 2030. Most recently, and just when Pfizer appeared out of the GLP-1 race, the $10 billion Metsera acquisition puts the company back in the center of the $100 billion plus obesity market, with a differentiated once-monthly platform targeting a 2028 launch and delivering $5 billion plus in peak annual sales potential. Combined with earlier bolts-ons like Arena, Biohaven, GBT, and the licensing deal with 3S Bio, Pfizer is well positioned to offset loss of exclusivity pressures and return to growth later this decade. Something we believe the market continues to materially underappreciate. Just at just 8 times earnings, the market is giving Pfizer zero credit for anything going right, making it one of the cheapest large cap pharma names on offer. If management is even half right on the roadmap, we see a clear path to a double over the next few years. If the full vision plays out and healthcare sentiment finds its way out of the doldrums, the upside is meaningfully higher. In the meantime, investors get paid a nearly 7% dividend yield to wait, more than 4 times the sector average, and backed by an 86-year-old payment history. 86 years of dividend payment history. The dividend is supported by a strong balance sheet with $15 billion of cash and cash equivalents and more than $10 billion of annual free cash flow generation. I love free cash flow generation. This life support valuation combined with an attractive dividend yield sets a firm floor and offers meaningful downside protection. Meanwhile, the bar for positive surprises remains exceptionally low as the market prices in virtually no good news. As execution progresses and new growth engines begin to show through, we expect sentiment to turn, and quickly. Until then, we are happy to sit tight, collect the dividend, and wait for this iconic American blue chip to reclaim its former glory. Earlier this month, management hosted an analyst and investor call to walk through 2026 guidance, recent acquisitions, and the long-term path back to growth. Here are the key takeaways, highlighted and underlined. And here are the 10 key points. Management fully reaffirmed its full year 2025 and adjusted EPS guidance of 3 to 315, and noted results are currently tracking toward the top end of the range. Full year revenue guidance was narrowed to $62 billion, consistent with the prior $61 to $64 billion range. 2, looking ahead to 2026, management expects revenue of $59.5 billion to $62.5, broadly in line with expectations, including 4% operational growth at the midpoint, excluding COVID and loss of LOE. Adjusted EPS is guided to $2.80 to $3, modestly below street estimate of $3.05, as several headwinds weigh on results. These include 22 cents of dilution from the 3S Bio and Metsera deals, a $1.5 billion decline in COVID revenue, representing 18% EPS headwind, $1.5 billion of patent expirations, and a higher tax rate rising to 15% from 11%, a 12 cents headwind. 3, the Metsera acquisition is gaining traction, with management guiding to at least 15 obesity drug trials in 2026, the majority in phase 3. The first Metsera product remains targeted for a 2028 launch, with meaningful contributions expected in the years that follow. Management also believes it now has the most advanced GIPR oral candidate in the industry, which it views as a significant opportunity to address the masses, with the only key monthly dosing data expected in Q1. 4, management cut 2025 COVID-19 sales expectations to $6.5 billion from $9 billion as global infection rates remain muted. COVID revenue is expected to decline further to $5 billion in 2026, representing just 8.2% of total sales versus 57% in 2022, as Pfizer continues to exit the COVID-driven era. 5, Pfizer expects $17 billion in annual revenue impact from the loss of exclusivity by 2030 relative to 2025, with a $1.5 billion LOE headwind anticipated in 2026. Management remains confident that the internal pipeline, along with acquisition of Biohaven, Seagen, and Metsera, and the licensing agreement with 3S Bio, positions the company well for 2029 and beyond to be strong growth years. By the end of 2025, the portfolio of recently launched and acquired products is expected to generate $10 billion in revenue, growing at double-digit rates, with growth expected to accelerate into the latter part of the decade and help offset patent expiration headwinds. 6, the cost realignment program is now on track to deliver the majority of the $7.2 billion in total net cost savings by 2026, a full year ahead of prior expectations, with $500 million reinvested to strengthen R&D productivity. 7, 2026 sales SI&A expenses are expected to be 12.5 billion to 13.5 billion, down from 13.1 billion to 14 point SG&A expenses, by the way. Okay, are expected to be 12.5 to 13.5, down from 13.1 to 14.1, representing a 4% year-on-year decline as cost savings continue to materialize. This is expected to support the stable gross and operating margins for the year, with adjusted gross margins projected in the mid 70% range and management seeing a clear path to consistently returning to the mid to high 70% range over time. 8, Pfizer expects robust operating cash flow in 2026, with the bulk of cash restructuring payments now behind the company and the final 2.6 billion repatriation tax payment occurring in 2026. With CapEx expected to be slightly above 3 billion for the year, this sets up solid free cash flow generation on a go-forward basis. 9, management reaffirmed its commitment to maintaining and growing the dividend over time, with the current quarterly dividend at 0.43 per share and the forward dividend yield now close to 7%. 10, management expects to exit the year with gross leverage slightly above the 2.7 times, which is expected to remain relatively stable through the LOE period. Entering 2026, Pfizer retains 6 billion of business development capacity. We've highlighted all the key things in the earnings call, and now we're going on to Albemarle. Note, we have taken profits on a portion of this position as it is now up 139% or 2.4x off our blended basis of 61.29 in a very short period of time. This is much faster than we expected. It remains a core position, but we don't want to be pigs, so we're taking some profits. So here are the key things we've highlighted and underlined for you. 10 key points. Number 1, revenue of 1.31 billion declined 3.5% year on year, but beat consensus by 28 million as 8% volume growth in both energy storage and Ketjen was more than offset by price declines of 16% and 5% respectively. Adjusted loss per share of 19 cents beat street estimates by 69 cents and improved 88% from the 155 loss last year. 2, despite lower lithium prices in Q3, management made meaningful progress on profitability, with adjusted EBITDA of 226 million, up 7% year on year, and margins improving 170 basis points to 17.3. Based on costs removed from the business and recovering lithium prices, management expects operating leverage could eventually push adjusted EBITDA margins above 30%. $15 per kg LCE. For context, lithium prices are now over $14 kilogram LCE, knocking on the door of management's target. Again, while this may seem like a big move from summer lows, it pays to zoom out. We are still in early days as it relates to lithium prices, which is why it remains a core position. 3, global lithium-ion battery demand for stationary storage jumped 105% year to date, led by North America and Europe at 145% each and China at 60%. The market has been a major upside surprise for management, with demand exceeding expectations and slower than expected supply growth tightening the market. Lithium demand for energy storage systems is now expected to increase more than 2.5x to a range of 430 to 1070 KT LCE by 2030 from 200 in 2024, implying a 15 to 30% CAGR and potentially reaching half of total lithium demand. 4, despite the noise, global EV demand remains strong, growing 30% year to date. This is mostly China. China continues to represent 60% of the global EV market, maintaining strong demand even after surpassing 50% market penetration. Europe accounts for 20% of the market with 31% growth, while the US makes up just 10% of the market with 12% growth. Global EV demand still drives over 70% of lithium demand, and management expects the market to remain healthy with continued growth ahead. 5, operating cash flow came in at 356 million in Q3, up 57% year on year, bringing year-to-date operating cash flow to 949, up 29%. Management continues to expect full-year operating cash flow conversion above 80%, well above the long-term target of 60-70%, driven by 350 million of customer prepayment earlier in the year and ongoing working capital improvements. Most importantly, Management now expects to generate $300 to $400 million in free cash flow for the full year compared to the year's original expectation of break even and last quarter's call for just positive. 6, management announced agreements to sell its controlling 51% stake in Ketjen's refining catalyst solutions business and Ketjen's interest in the Eurocat joint venture for combined pre-tax proceeds of $660 million. Both transactions are expected to close in the first half of 2026, with proceeds supporting further balance sheet deleveraging. 7, Albemarle further lowered full-year capex expectations to $600 million, a 65% decline from last year's $1.7 billion and exceeding the original plan for a 50% reduction as management focuses on projects with the highest returns on capital and fastest paybacks. Looking to 2026, management sees a further 10% decline as reasonable, emphasizing that current capex maintains assets and reflects efficiency gains rather than underinvestment. 8, management continues to strengthen the balance sheet with $1.9 billion in cash and cash equivalents and total liquidity of $3.5 billion. Total debt stood at $3.6 billion, fully fixed at a weighted average rate of 3.6%, resulting in net debt to adjusted EBITDA of just 2.1 times. Following the Ketjen transactions and the Q4 debt repayment of $440 million, near-term cash is expected to reach $2 billion. 9, management is now on track to deliver full-year run rate cost and productivity improvements of $450 million above the initial target of $300 to $400 million, with sales, administrative, and R&D expenses now down $166 million or 22% year to date. And 10, management now expects the full-year outlook to land at the higher end of the previously published $9 per kg scenario, which called for sales of $4.9 to $5.2 billion and adjusted EBITDA of $800 million to $1 billion, driven by stronger lithium pricing and full-year volumes expected to exceed 10%. Keep in mind, this guidance was issued in early November when prices were still below 11.5 kg, suggesting meaningful upside to those numbers based on today's prices. Here's the earnings call highlighted. You can read it at the website, hedgefundtips.com. And now on to the market. By the way, Morningstar has a $200 per share fair value estimate, and we think it can work its way up there over time. Not at the same pace that it's 2.4x, but certainly grind higher over time, which we love and why it continues to remain a core position. Fear and greed is neutral for the market. And congratulations to all the new clients that came in intra-quarter Q4 with the larger sized accounts, 5 million plus. And to those existing clients who upsize their contributions to their accounts, existing clients can send in money to their own accounts whenever they want. They don't have to wait for the quarterly stuff. Whereas we are now reopening smaller accounts for the $1 million plus accounts starting January 1st. Some of you have already, we said you could come in early and get things started last week. We've had quite a few people get started and take advantage of that. Those interested in going live on January 1 can begin the onboarding and application process ahead of time. We are putting money to work that comes in early because we want to get exposure to this new position quickly. And to see if you qualify and to take advantage of this opening, click here. Just basically go to hedgefundtips.com, click on money management. Larger accounts of $5 to $10 million can access bespoke service anytime. And same link. They don't have to wait for the quarterly openings like the smaller accounts. Not a solicitation, opinion, not advice. Consult a psychic before doing anything. Defense and aerospace earnings estimates and revisions. Top 30 weights. In the last 60 days, their earnings have been revised down by 6 basis points. So basically flat. Energy top 30 weights last 60 days revised up 23 basis points. Economic data has been better than expected this week, even on the jobs front. Estimates for earnings next year are still $309, which has come up quite a bit since the summer. And now we're going on to many people's favorite part of the week, which is the Ask Me Anything questions. For those of you who don't like the Ask Me Anything questions, thanks for joining. Merry Christmas. For those of you who do, here we go. Our first question comes in from Ron Burgundy. Sounds like someone from, I forget what movie that was with Will Ferrell, but okay, Ron. Celanese, I don't know. Do we cover this one every week or every other week? We continue to look at it, and what we continue to say is we like it. but it's not without risk. They got balance sheet risk. If it works, you're going to be up 5x. Excuse me, not 5x. If it works, you're going to get yourself a triple. And I think you're going to be fine with this one. We would like to get more exposure to materials, but there are only so many positions we can have in the portfolio. Let's take a look at the balance sheet. 140 million of cash. You got 1.6 billion of receivables, and you got $11 billion of debt. So you got to really know when that debt is coming due. I think they're going to figure it out. I think this cycle is going to change. $1 billion of free cash flow, they'll figure it out. Let's look at the income statement if they did anything stupid raising equity. And the answer is no, they're bringing down the share count modestly. So we like that. I think you're going to be okay here. We like the idea. Way to go, Ron Burgundy. On to the next. Jay Elay. Okay. Wants to know about Goose. And Jay says they're burning cash. Well, Jay, your numbers are wrong. They continue to generate record free cash flow, record revenues. Stock is still down, even though it's had a huge move off the lows and off of our basis. It's just getting started. So check yourself before you wreck yourself. Go directly to the SEC filings. If you don't have COIFIN, that pulls directly from the SEC filings, and go from there. Barry Kimbrough, what's your thoughts on Align Tech? We don't like Align Tech, but we do like the space, and we are going to leave that there. Align is not for us. It could work, but we have no edge there. Manny B, ConMed, CNMD. I think we covered this a couple weeks ago. And I think we said okay. Let's just double check that. Yeah, I think you'll be okay there. Next, Jack Law Comber, Dublin, Ireland. How you doing, Jack? WDFC. What is that, WD40? It's okay, but there are higher and better uses of your cash. You're certainly not going to get a double off of it. And, with declining revenues, well, no, revenues are okay. I just think it's rich. I wouldn't be a buyer here, but I don't think you're going to get hurt. Harry G, Bristol Myers. It definitely clicks the healthcare box. This one's not for me, but I think it's going to work with the whole sector. It's been flat. I think it's probably on its way to do better things than it's been doing for the last 5+ years. So I would say okay, but Pfizer's better in terms of multiples you can get depending how you express it. Jason M, we're going to get back to you on that one. We can't talk about it now. You can interpret it that as you will. Tom, Merry Christmas. Nike. We like Nike. We like the turnaround. As a matter of fact, one of their directors named Tim Apple, aka Tim Cook, bought a ton of stock, or not a ton. He bought $3 million of stock. And I think this one's going to work. I think it's going to take longer than everyone thinks. And I think VF Corp is a better bang for your buck because you're going to get a higher multiples. When Nike recovers, you get a double. When VF recovers from our basis, you get 3 to 5 bags. And we like 3 to 5 bags better than a double. So BHC, this is from Max M. BHC, is this? Yeah, it's Bausch. This is a value trap. It's probably going to work. I mean, all these guys, Paulson, they've been in it forever, and they continue to. It's been a bad use of capital. I just don't see the growth. It's okay. This is a value trap. That's not what we do. It could work, but I don't think it's going to be great. Wabash National, WNC. Revenues declining, cash flow declining, WNC. Yeah, I mean, but you're probably going to wind up with a double on this one. Let's just take a look at the balance sheet. Engineered solutions for logistics. Well, logistics is going up. We know that from our position with GXO. Let's just see if they're going to stay in business until the cycle turn. So this is an issue. They got 91 million of cash and 160 million of receivables on $400 million of debt. That's not bad. Let's see what the cash flow is doing here. Yeah, they're going to live 100 million of cash. Let's take a look at their income statement. Bringing down the share count. I think you're okay there. Next, Kim Arnold, Amphastar Pharmaceuticals. When we get to smaller companies, I tend to not do individual stocks because I have no edge on the drug approval. We're generalists. So I would say it's not for me. Next, Christian D. What's your opinion on Howard Hughes? They'll benefit from the housing recovery. This is Ackman's new vehicle. Not for me. Next, Brian McLean. Now Newell's a bag of you know what. It'll work for a bounce, but it's just been so mismanaged. Ricardo Agosto, first time caller, Goodyear Tire. The answer is no. There's too much competition from the Koreans and the Japanese. And the other thing is, this is going to work for a bounce, and it's going to be fine in the short term. It's just such a crap business, and it's just burning too much cash. Revenues are showing no sign of recovery, so it's a trade and a gamble, not an investment. VNOM, this is a lower quality energy producer. I think energy is going to play well in 2026. There's no way I'm buying it up here. So hard pass. Jack G. Jack, we covered that in the article of the week. What's causing that for next year and why are we not concerned? This is a new investor inquiry. Greg's UK, GREGG. This is a Dunkin' Donuts of the UK. Let's take a look at it. Negative free cash flow. Revenues are growing. Let's take a look at the balance sheet. $45 million of cash. How much debt? $500 million. I wouldn't do this one. I like it looks like it wants to bounce and maybe you'll get a double, but they're better uses of your money. Another investor inquiry. Simon, Baidu, we own it from much lower levels. Another investor. And SM Energy from Sagar Kanakaya. SM, another energy company. We like that theme. I don't think this has come down enough relative to the price of energy. There are better energy plays like we like Comstock, which, yes, it's up almost triple from where we bought it, but it's going higher. National Oil, well, Varco is only up 40-50% from where we bought it. That's going to be a multi-bagger even from these levels. I would play it that way. These E&P names I don't think have come down enough relative to the price. Plus, this one's burning a ton of cash, so hard pass. And that's that. With that said, we'll see everyone next week. I don't know which day, but it will be same place, either Wednesday or Thursday. In the meantime, make it a great one. Merry Christmas and bye for now.